Today, how to fix housing affordability, Kiwi style, but how to get a smarter north from digital finance analytics. Well, there's posts covering finance and property news. Despite the Reserve Bank of New Zealand cutting the official cash rate by 2.25%, and with further rate cuts expected, New Zealand home prices nationally are down nearly 17% over 45 months, and are only now 3.4% higher than 5 years ago. Add inflation, and they're actually really lower. This despite the reduction in the cash rate that's driven down the costs of new mortgages. Of course, the reduction in migration is part of the reason, mirroring data I discussed recently from Canada. Net overseas migration into New Zealand is at a 2.5-year low due to a surge in residents, guess what, seeking better opportunities in Australia. ASB notes that home prices are being pulled down by the recessionary economy and rising unemployment, while easing net migration inflows have further exacerbated the imbalance between housing demand and supply. In fact, real home prices in New Zealand are back to pre-pandemic levels. The broader economy is stalling, with the nation's labour market seeing unemployment and underutilisation rates soaring to near decade highs, outside of the pandemic, that is. New Zealand has lost around 40,000 jobs since late 2023, with younger workers bearing the brunt. ANZ senior economist Miles Workman has warned that New Zealand's unemployment rate could soar to 6% if firms cease hoarding and right-size their workforces. New Zealand is also now operating with a 15% US tariff on around $9 billion of its goods exported to the US, their highest level since the mid-1930s. Meanwhile, the fiscal screws are tightening amid rising national debt. Austerity measures have reduced public sector administration jobs by around 15,000 from a year ago. Now, the net result of all this is actually that housing affordability in New Zealand is rapidly improving, with mortgage repayment affordability at a decade low. A lesson here, perhaps, for Australia? Well, it depends what you want, I suppose. Mind you, the Real Estate Institute of New Zealand just released their figures for July, showing that while sales activity has increased compared to the same time last year, listings were lower in July 2025 than a year earlier, despite a modest month-on-month rise after a significant drop in June. And the national median price increased slightly year on year, reflecting a slight rise amid an otherwise steady trend, they said, with monthly movements shaped by seasonal factors. The median price for New Zealand increased by 1.8% year on year, reaching $767,250. Excluding Auckland, the median price increased by 3.9% year on year to $695,000. Auckland's median price increased by 2.6% year on year to $975,000. 11 out of the 16 regions reported an increase in median prices compared to July 2024. The most significant year-on-year increases were recorded in Nelson, up 15.7% from $657,000 to $760,000, and in Otago, up 11.1% from $657,000 to $730,000. Data shows a broad-based resilience in property values, with property growth in some areas, which suggests that local markets are responding positively to buyer demand despite winter conditions, the REINZ said. Compared to June 2025, the seasonally adjusted data indicates a slight increase in New Zealand's median price. While some regions saw notable price growth, others experienced declines, highlighting a mixed housing market across the country. The number of properties sold across the country increased by 4% year on year, increasing from 6,074 to 6,319. When excluding Auckland, sales increased by 6.1%, from 4,166 to 4,421. Looking at the regions, 8 regions recorded year-on-year increases in sales, the highest of which was recorded in Nelson, which saw a 43.6% increase, but from just 55 to 79 sales. Other regions with notable sales increase include the Bay of Plenty, up 18.9%, Hawke's Bay, up 13.5%, and Northland, up 10.5%. Seasonally adjusted sales counts at the national level show sales were slightly down. Sales growth varied widely. across regions, with strong rises in areas like Northland, while some regions experienced declines, reflecting a varied sales market across the country, they said. Looking at the new listings, New Zealand saw a 4.2% decline in listings compared to July 2024, totaling 7,737 new listings. There was also a decline in listings for New Zealand, excluding Auckland, down 5.2% to 4,925. Inventory levels across the country also recorded a decrease, down slightly by 0.4% year on year to 30,430. In July, there were 853 auctions recorded, which represented just 13.5% of all sales. For New Zealand, excluding Auckland, there were 475 auction sales, which was just 10.7% of all sales. The Bay of Plenty recorded the highest percentage of auction sales, with 21.4% of all sales being done by auction. The median number of days to sell for New Zealand declined by 1 day to 48 days, and the same was recorded for New Zealand, excluding Auckland. While buyers remain active, local salespeople around the country say they're not in a rush to purchase. With the median days to sell holding steady or improving slightly, it's clear that buyers still feel they have time to assess the market, the REINZ said. The house price index, by the way, for New Zealand is currently at 3,564, showing a year-on-year increase of 0.1% and a decrease of 0.4% compared to last month. Over the past 5 years, the average annual growth rate for the HPI has been 3.4%, but of course, that doesn't really tell you the full story, as I discussed earlier. The REINZ noted that local salespeople believe most vendors are realistic and are meeting current market expectations, but due to declining listings volumes, winter conditions, and uncertainty about buyer behaviour, many are preferring to wait until spring, when activity usually increases and confidence tend to lift. But all up, given the stretched public finances, ASB has called for deep interest rate cuts from the Reserve Bank to drive growth. Fiscal policy needs to now be focusing on rebuilding buffers rather than depleting them, they said. Continued structural fiscal deficits will not put the government's balance sheet in the position that it needs to be in. Taking the OCR back to around 3.25% neutral level won't do it. It's time for number 2, the terrace, to assume the growth pattern from number 1. The RBNZ needs to quickly transition from tapping the monetary policy brakes to pressing the accelerator. How much will be needed depends on the economic outlook. How far and for how long the RBNZ will need to apply the monetary policy accelerator is unknown, but it looks increasingly likely that the OCR will be below 3% by the end of 2025. So the point to all this is this: if you choose to close down migration, the economy moves quickly into stall speed. So it's Hobson's choice, it seems: flood the country with more migrants and feed the housing market frenzy, or cut migration and watch the economy collapse. Decades of bad policy have led to this, and ordinary households are paying the price one way or the other. But it'll be interesting to see whether ultimately Australia or New Zealand and Canada, who are following parallel paths, win out. But for me, the bottom line is simply this: the migration part of the story is a huge part of the story of the trajectory of home prices. Cut migration, home prices will fall. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.